Next guest has some names she says are still attractive opportunities despite this latest push higher. Joining us now is Samantha McLemore, founder and CIO of Patient Capital, formerly worked with famed value investor Bill Miller before starting her firm in 2020, brought in Miller's opportunity equity business earlier this year, and of course he's still an advisor to you. Samantha, great to have you. In your January investor letter, which came after a rough 2022, you wrote, investors get spooked at exactly the wrong time. Reversion to the mean is a powerful force in markets. Well, after a day like today, investors also get greedy at the wrong time, and reversion to the mean from the highs we've got now could be painful. So to be consistent, what should investors think about differently now?
Well, I think there definitely is reversion to the mean potential, except markets go up 70% of the time. So I think your base case is for markets to continue to rise. When we look broadly, we still see a lot of skepticism and pessimism out there. So I think if you look, the market typically rises, or over the last 5 hiking cycles, has risen 10% between the last hike and the first cut. So that would imply another 6.5% upside, into that first cut, whenever that is between March and June, call it. So we still see upside from here.
Okay. Now, I want to ask specifically about innovation stocks. Some would consider, even though it's big, Adobe one of those. We just got its report. It is down about 5.5% right now in overtime. Unlike a lot of value investors, you don't stay away from these stocks, but what kind of filters are you putting on them now to understand what's worth buying at these levels?
No, that's a great question. I think that those companies that can grow and compound value often are the best values. I think what we see now, though, is a generational buying opportunity in classic value or low multiple stocks. So we've just gone through a decade of some of the best returns ever for growth and for these compounders. So that's taken expectations up. I think Adobe is a good example of that at 40 times earnings. So the results have to be very strong to continue to surpass that. And on the classic value side, I think we just see expectations that have been ground down to such a low level that the returns are much more attractive there.
So what's an example of classic value, and how do you differentiate between that and a value trap?
Yeah, so I think classic value, we would say, looks cheap on the multiples. Everyone would recognize it as value. Bill was criticized early in his career for not being a true value investor because he did invest in names like Amazon, Dell. Now people recognize that those can be the best values in the market, but we see a number of low multiple names that we think have been completely ignored, names like Citigroup, like Delta, like General Motors, where expectations are just so low that you don't need a lot to go right for those stocks to compound, we think, at rates above 20% per year from here.
You just mentioned Citi, General Motors. You call this a misunderstood story. You've got another one to share with us, too, OneMain Financial. I guess break down your theses around these names.
I think Citigroup has been a laggard and an underperformer for decades. So people think they can ignore it because it has low returns on tangible common equity. But I think Jane Fraser is finally making all the right moves to fix that and improve those returns. So they've gotten rid of businesses, they've simplified the organizational structure, they're investing in technology. They already have some businesses like their services business that she calls her crown jewel that's earning 20+% returns. So we think Citigroup can earn $13 a share in 2026. The market's at $7. The market doesn't expect them to grow earnings at all. So we think that stock will be over $100, by that time.
I want to zero in on the other part of Morgan's question on OneMain Financial and really on regional banks, because I think the KRE actually closed above 50 today. It had been down in the 30s not long ago, earlier this year. How are you distinguishing in this environment where regionals are catching a bit of a bid on where there's danger versus where there's value?
Yeah, I think the interesting thing broadly about these names is CECL requires banks to take reserves upfront for losses. So most of these banks and credit companies have already reserved for an unemployment rate 4.5%, 5%, even 5.5%. So that's already baked into the current fundamentals. So people have been very concerned about things like commercial real estate, other things. If we have a recession, it will be the best broadcast recession we've ever had, which have given these banks lots of time to prepare. But we're always looking at the balance sheet. So a name like Citigroup or like One Main Financial, we just don't see significant risks in those areas that might be of concern, like commercial real estate or credit cards.